Hey everybody, welcome back to More Than Commas podcast, where we explore the truth that wealth is about more than just dollar signs. I'm your host, Paul Adams, and today we're going to talk about something that I promised in a previous episode, which is how to arrange your investments in a way that it protects your real estate portfolio. You see, real estate can be one of the most powerful wealth building tools that somebody can have on their balance sheet. But it also is one of the only tools that has the ability to hold the rest of your finances hostage. So today I'm going to walk you through a simple framework we use with our clients that helps them stay in the real estate game without exposing the rest of their net worth to risk. So before we dive in, I want you to not forget to subscribe, comment, leave a review, share this episode with someone you know, and send us an email and tell us about a future episode you want to hear. Now let's get into it. You see, when people first step into real estate investing, they often look at the most successful people. They see the millionaires, they see these big real estate portfolios, these financial independent stories, and they think to themselves, that's the roadmap. And you hear these stories of these titans that were heavily leveraged and barely made it through some crisis. But what they don't see are all of those that failed. You see, that's survivorship bias. And survivorship bias means that you only see the people who quote unquote made it in real estate, not the larger number of people that were over leveraged, perhaps at the wrong time or when their job got shook up. Those people aren't on podcasts, they're not on stages, they're not at conferences talking about the difficulties and losses they had in real estate, because uniquely, when real estate failures occur, there tends to be more shame for the average investor than, say, buying some individual stock. You see, the reality is that many of these real estate fortunes were built on luck combined with leverage. They were also had skill in there, but the timing worked out. The market went their way. And while the wealth is real, their story is just incomplete. Because for every one of them, there's dozens of balance sheets that were totally ripped apart, and it was wiped out because of vacancies, tax hikes, repairs, or some sudden need to sell that property at the wrong time. That's the risk most people don't want to talk about, and that's why today's conversation matters so much. Now, you might be tempted to look at your real estate returns and think, wow, I am doing so much better than my stock and bond portfolios. And in many cases, that is true. But the reason isn't because real estate is a magically better asset. It's because it's an asset that you were able to bring your human capital to bear on. You were able to bring your human capital into the investment. Your knowledge, your hustle, your relationship, that's what allows you to get a higher rate of return in real estate. You want proof? Look at all the people who didn't properly educate themselves about real estate, whose balance sheets got completely wiped out because they went in without the appropriate amount of human capital. The mistake comes when people take that success, let's say they have a beginning success, and then perhaps the only experts they listen to are real estate or mortgage experts. Maybe even dismissing prudent financial advice from advisors who are in the financial advisors simply because you feel like they're oppositional to you. Like, oh, you want my money invested there instead of in real estate. And frankly, for many advisors, that's not an unfair assumption. Plenty of advisors just simply don't understand how to advise or help clients who have real estate, so all they have is opposition to anything that's not something they can sell or take under management. But here's the truth. Real estate and investing and building a portfolio can and should complement one another. The key is structuring the remaining part of your balance sheet so that you can persist in real estate without putting everything else at risk.
This episode is brought to you by Sound Financial Group. At Sound Financial, we specialize in helping clients build strong, long-term financial strategies for their retirement. If you're looking for personalized advice to help manage your wealth, visit us at sfgway.com to learn more about how we can help you achieve your goals.
Now, here's the challenge with real estate. It's the only asset class you have on your balance sheet that can hold the rest of your balance sheet hostage. Now think about it. If your mutual fund drops in value, it never calls you and says, hey, I need a new roof, but real estate does. Like when the property needs a new roof for $20,000 or $40,000, or the AC breaks down and that's $8,000. When the tenant leaves, but the mortgage still needs to be paid. When property taxes go up, or as we're seeing across the country right now, unexpected increases in insurance costs, or if you get a squatter who you can't eject from the home and it seems like the law is on their side for the next 6 months, but you still have all the expenses and damages to repair before that little business of a rental property can make you money again. You see, those aren't theoretical risks. They're certainties that show up for any real estate investor that stays in the game long enough. This is not it might happen. It's that it does happen to anybody who owns multiple doors over long periods of time. Every property owner are going to experience these. And when they happen, they don't politely wait for a convenient time. They demand cash now. That's why so many people lose money in real estate. It's not the property itself. It's not that it wasn't valuable, but because you were forced to sell. A cash flow crunch, a job loss, an unexpected repair pushing you into the position where the property has to be sold. This is the biggest cause of all loss in real estate, is being forced to sell when you don't want to. Here's the problem when you lose a piece of real estate. You lose the property, you lose the cash flow, but you also lose whatever leverage you already had locked in at whatever rates you had. You may lose the appreciation, and what you're also losing is the long-term value creation that would have continued had you been able to leave it on your balance sheet. So how do you protect yourself? Well, we recommend a very simple framework of the rule of half. Here's the basics. Whatever debt you have on your investment properties, not your primary residence, or maybe even a second home, if those just sort of fit into your regular budget, but your rental or commercial properties, you should have half the amount of those investment mortgages in liquid, non-qualified investments. Think stock and bond portfolio or a portfolio of ETFs. That could be an individual account or a joint account with your spouse, but it's not tied up in retirement accounts and not locked in any illiquid assets. So I'm going to give you a simple example of how this might work. Say you have a $500,000 rental property that you purchased with $100,000 down, and you have a $400,000 mortgage at 7%. Now, if you follow the rule of half, what you would have done is put $200,000 into a non-qualified account that you could access and liquidate in the case of emergency. And let's say that's just sitting there. It's not a dead asset. We're not leaving it in cash, but let's say that asset over time grows at 8%. Now, if we do some very simple math, the annual debt service on a $400,000 mortgage at 7% is about $32,000 a year. That's both principal and interest. But let's say you had some traumatic thing that occurred with that property. Values are down or you can't get much in the way of rent for a while. You can cover that mortgage for 6 years without a renter paying a lick of rent. And that's not counting the fact that those investments grow over time, or that they might be gaining interest while we're making distributions to save the real property. You see, that's the safety net. That's what allows you to hold on through vacancies, recessions, or unexpected repairs. In this case, this person go a full 6 years, even in this high interest rate environment, servicing the debt on that property, putting themselves in a position that they can sell when they want to sell, not when circumstances dictate it to them. So if you scale that up, the math still holds. If you've got $1.5 million in debt across multiple properties, you'd want $750,000 in non-qualified investments that are liquid. Because what you don't want to do is be in a position that, let's say for a period of time, those properties you own are worth $2 million. But that's when you're forced to sell. Having to sell even in a down market, and you could go back and look at this in 2008, 2009, 2010, that yes, the markets were down, but they were not down anywhere near as much as the real estate. And the risk of the real estate is because all of our equity is on top of that loan. So when the real estate goes down in value, that leverage is so valuable to us in acquisition and returns on cash flows. But when that value goes down, none of the bank's money goes at risk. Your money gets all erased first. So those downturns in the market, especially in real estate with leveraged properties, can erase a great deal of net worth. And that's why we want to have the investment funds on the sideline ready. Even if we had to sell them at a loss, it's unlikely to be near the loss that we're mitigating by having this backup plan for the real estate. Now, lastly, with an investment portfolio and an advisor that understands how to coordinate it with your real estate, what you could also do is consider an asset-backed line of credit. An asset-backed line of credit is going to give you the ability to borrow funds against that investment portfolio without even needing to sell a security. And we've had clients do this for temporary liquidity on real estate transactions, finance the new piece of real estate with the cash from this asset-backed line of credit backed up by their investment portfolio. Then they had time to be able to sell the prior property that was leveraged, and they had the end property that they ended up in totally paid off. Once the first property sold, they were able to retire the line of credit on the investment account. So here's the bottom line. Real estate isn't bad. It's good. It's just a tool. But like any tool, it can build or it can destroy. The investors who thrive in real estate aren't the ones with the highest returns in the good years. They're the ones that build their balance sheets in a way that ensures they never have to sell in the bad years. So if you're building a real estate portfolio and asking yourself, do I have the rule of half in place? If not, now's the time to start. And if you have an advisor that doesn't understand your real estate ambitions, give us a call. We'd be happy to share our philosophy with you and guide you a little bit on how finances and good financial plans can enable a real estate portfolio, and that real estate portfolio can enable a good financial plan. As always, I'd love to hear your thoughts. Drop a comment, share your own experience, or tell me where you've seen people get into trouble in real estate. And then, as always, keep an eye out for more conversations about building wealth with wisdom and discipline. But that's it for this episode of More Than Commas. Remember, the goal isn't just commas in your bank account. It's building a life that truly matters. Thank you for joining me today. And as always, that's it for this episode. Now go back to living a great life.